Good afternoon. This is the Investment Committee of CalSTRS meeting that will commence. Would you please call the roll call, please?
Miss Bradford.
Here.
Miss Hendricks.
Here.
Mr. Keeley.
Here.
Mr. Gunning.
Present.
Mr. Tang.
Here.
Miss Erden.
Here.
Miss Yamamoto.
Here.
For the State Superintendent of Public Instruction, Miss Nocito.
Here.
For the Director of Finance, Miss Whitaker.
Present.
For the State Treasurer, Mr. Ruffino.
Present.
For the State Controller, Miss Paquin.
Here.
Chairperson Prezant, you have a quorum. Chairperson, if it's okay with you, I will now proceed with reading a preliminary note.
Yes, go ahead.
The CalSTRS board meetings are live web streamed and video archived and available to the public on calstrs.com. Individuals who wish to address the board should wait for the 10-minute public comment period at the end of the agenda item the speaker wishes to address. For comments not pertaining to a specific agenda item, there will be an opportunity for additional statements at the end of the open session. Each speaker is allowed a maximum of 3 minutes to comment. However, if there is not enough time for each speaker to have 3 minutes, the timing will be at the discretion of the chair. To protect the privacy of speakers under the age of 18 who wish to address the board, only their first name and affiliated organization may be provided, but other personal identifying information, such as their last name, age, or school, may not be shared. That's all I have, Chairperson.
Thank you very much. I would like to get a motion to approve the agenda.
So moved.
To approve. Second.
If there's no opposition, the agenda is approved. Any public comment?
There is nobody in the queue for public comment at this time.
Great. Well, I want to welcome all of the participants in our program today. And I will hand this over to Geraldine, who will make the introductions and describe what we're going to do today.
Thank you, Chairman Prezant. Today, we're following up on the asset liability management study. It's further education following on from our November meeting. You may recall in November, we introduced the subject of private credit and in particular direct lending that we were adding to the modeling for this asset liability management study. But real quick background, CalSTRS has many years in private credit space and private equity and the real estate portfolio. And then around 2017, we decided to incubate private credit, in particular direct lending, to see if it would be additive, meaning improve our diversification overall in our return profile. The incubation portfolio, that's the purpose. So we think it's positive. We want to model it in. So you approved some assumptions in January, and this is just more information for the board. So this is definitely your meeting. When we do build out private credit and this direct lending, it will be in the fixed income Glenn Hushkawa's portfolio. So he's here also, should you have questions. But we did invite Richard Grimes here from Cambridge. He started in November and introduced the subject, and we invited 3 of our key partners in this space with their extensive knowledge. So I will let Richard introduce them, but I'll hand it over to Richard now.
Great, thanks, Geraldine. Good afternoon, board members. Speaking on my behalf and on the behalf of my fellow panelists, we appreciate the opportunity to have this conversation with you today. Before we get into today's conversation, I did want to recall a few comments from the discussion I had with you back in November that I think will help frame today's conversation. The first point, and Geraldine touched on this, with the increased use of the term private credit in recent years, not just in what I would describe as trade rags, but more broadly, it makes it feel like a new asset class. It's certainly an asset class that has grown and evolved, and it's an asset class whose influence in investors' portfolios has grown, but the underlying sub-strategies are not new. As Geraldine just said, your investment team has been investing in private credit for years. And in fact, Cambridge Associates has been advising on and investing on behalf of our clients in private credit for over 2 decades. Secondly, it's a diverse asset class. You may recall from our last conversation in November that we showed a chart that had a lot of underlying sub-strategies of private credit. So when we talk about private credit, we can be talking about strategies that provide the most downside protection, rely on contractual returns, and generate consistent current income. And that's what we're going to be focusing on today. But there's also credit strategies that intend on generating even higher returns by deriving a portion of those returns through capital appreciation, as well as strategies that attach to varying types of collateral. So it is really a diverse landscape. And again, as Geraldine had stated, that's why your private equity team is involved in private credit, your real estate team, your innovative strategies team, and now through fixed income. So it is a diverse space. And the last point, which I think I left with you back in November, that I would hit on up front is that for a sophisticated investor like CalSTRS that can afford illiquidity, Cambridge recommends private credit be a permanent home in your portfolio, and increasing private credit's role in your portfolio would be complementary to your total plan. So with that, let's pivot to today's discussion. We're here to talk about direct lending in further detail and how direct lending can play as a nice complement to your fixed income portfolio, and why now could be an opportune time really to increase that influence in your portfolio. Without further ado, let me introduce the panelists who've joined us today. We're joined by leaders of investment platforms that are leaders within the direct lending and private credit space, so a lot of leaders. First off, Mitch Goldstein is a partner and co-head of the Ares Credit Group. He serves on the Ares Executive Management Committee, serves as co-president of Ares publicly listed business development companies, or BDCs, and as a member of multiple investment committees, including Ares Credit Group's U.S. direct lending strategy. Prior to joining Ares in 2005, Mr. Goldstein was in investment banking at CSFB, DLJ, Indus Suez, and Bankers Trust. And Ares Management as a platform was formed in 1997, is a publicly traded global alternative asset manager with approximately $341 billion in assets under management, and provides global coverage of the private credit space with over 30 offices. Craig Packer is co-founder and a senior managing director of Blue Owl. Craig is a member of the firm's executive committee and board of directors, serves as co-chief investment officer of Owl Rock Capital Partners, Blue Owl's direct lending platform, chief executive of the Owl Rock BDCs, and a member of those investment committees. And prior to founding Owl Rock, Craig was a partner and co-head of leverage finance and served on the firm-wide capital committee in the Americas at Goldman Sachs. Prior to joining Goldman in 2006, Craig was global head of high yield capital markets at CSFB and had worked at DLJ before that. Blue Owl's direct lending platform, Owl Rock, was formed in 2016, and Blue Owl has approximately $132 billion of assets under management, covering direct lending amongst other strategies across 10 offices globally. And Mike Patterson is co-founder and governing partner of HPS Investment Partners, where he leads the direct lending platform. He serves on the firm's investment committee and is the portfolio manager for the specialty loan funds and the core senior lending funds, and is CEO and chairman of the HPS Corporate Lending Fund. Mr. Patterson joined HPS in 2007, prior to which he was with Silver Point Capital in the US and Europe, and Goldman Sachs in its principal investing area. Prior to his investing career, Mr. Patterson served as an officer in the United States Navy. And HPS as a platform was founded in 2007. It's a global investment firm with approximately $95 billion of assets under management, focused on private and public credit across 15 offices globally. And then as a reminder, I'm Richard Grimm, a managing director in Cambridge Associates New York office. I co-lead Cambridge's private credit effort, working closely with predominantly pension clients in portfolio construction and management, as well as leading investment diligence and serving on our firm's credit ratings committee. Prior to Cambridge, I have roughly 25 years of direct investing and leverage finance experience, having been involved in many of the sub-strategies of private credit while at Soros Fund Management and successor entities, and starting my career in investment banking at DLJ. Cambridge, founded in 1973, is a global investment firm and advisor with approximately $540 billion of assets under advisement. working with leading pension, endowment, and foundation and family office clients across 12 offices globally. So now what we wanted to do, just in terms of format, we had I think a great two-way conversation in November. We certainly would encourage board members for you to interject at any point along the way. We did come prepared with 4 slides that we think are helpful in carrying us through the conversation. And with that, why don't we pull up the first slide, which is really in some ways, the why private credit slide. Great. So this is a slide that we shared with you in November. Rather than me walking through some of these, I think, core characteristics, and in particular core characteristics to direct lending, I'd love to pull in our panel. So leading off, why don't we, Mitch Goldstein from Ares, if you don't mind, could you tell us a little bit, and this will frame out, I think, the downside protection point as well as the lower correlation point, but could you tell us a little bit more of what does your typical borrower look like? What are borrowers using the loans for? If the loan was used to acquire a company, how much of that purchase price is being provided by you, a direct lender, and how much would be coming from equity or subordinated capital?
Yeah, thanks, Richard. Thank you for that introduction. And on behalf of Ares, my partners at Ares, and I think all of us, really thankful for being invited to your board meeting. A lot to unpack there, Richard. So let me start. The typical borrower for our companies, and they run the gambit, but they're known as small or medium-sized businesses, or SMEs. And for the most part, they tend to be $50 to $100 million of cash flow or EBITDA. That's the term we use in the industry. They have very strong margins. They generate a lot of free cash flow. They tend to have very high growth rates. They have strong market positions. They have lots of different suppliers and lots of different customers. They tend not to be cyclical, meaning they perform in both good markets and volatile ones. And finally, they tend to have value to others, either a private equity firm or a competitor in the industry. And so when you touch upon what our loans are used for, you're right, Richard, a lot of our loans are used for buyouts, private equity firms buying these types of companies. So we tend to, our capital tends to be used what is known as acquisition finance. The private equity firms are acquiring these companies. And you're right, there's tons of downside protection. When you think about the benefit of these loans, at least the way we invest them, they have tons of downside protection. So in your example, typically, a firm will have 40% of our capital or senior capital when you're talking about that particular security, and 60% either equity or junior capital. So in an example, again, if a private equity firm is buying one of our companies for $1 billion and they use, just for ease of math, $500 million of equity and then $500 million of our loans, we have a loan that is 50% loan to value. So if the company grows or doubles or triples, we still get our capital back, right? And all the interest and all the income and all the fees that these loans generate. Again, those are the returns and the income generation that our loans provide. Conversely, and this is the lower correlation, if that company doesn't do as well and the value then is reduced to 900 or 800 or 700, et cetera, as long as it's above 500, we are going to get our money back. All the while, again, providing that income and the consistency and durability of that income to our clients. And so that's what we're talking about when we think about risk-adjusted returns. And finally, as you think about downside protection, I apologize for running on. We think of downside protection in a couple of ways. It is our second and third way out. Right? If the company doesn't have the cash flow to pay us back, hopefully they have assets we can sell to pay us back. Hopefully it is worth, again, it has value to others that will buy our company north of our loan to pay us back. So we think about downside protection all sorts of ways as we're making our loans to our companies.
Great, thanks, Mitch. No, that was really helpful. I think, Mike, if we could then, from HPS, if we could then wade a bit deeper into how you originate these investments. And board members remember back in November, we described that, the term direct lending comes from the fact that an Ares, an HPS, an All Rock is providing these loans directly to the borrower. There's not an intermediary like an investment bank that would be working with the borrower and then syndicating these loans out. So Mike, if you could tell us a little bit more about how these loans are arranged or originated by you. And while the vast majority, well over 80% of the direct lending market really provides capital to private equity owned businesses, HPS in particular also emphasizes non-sponsored lending, so i.e. not having a private equity backer. Maybe you could just touch on the differences in that approach and how on the front end this all works.
Great. Yeah, and I'll reiterate Mitch's thanks to CalSTRS for hosting us today. I think the origination process is one of the aspects of direct lending that makes it a really distinct business and frankly, a very manual business. We each maintain staffs of senior investment professionals whose primary job is to go out and meet companies, determine ones that they think are creditworthy, and then bring those back and try to create a transaction. So it is very much a boots on the ground business. And those staffs will cover private equity sponsors and try to help evaluate whether the deal they're talking about, the company they're thinking of buying, would be an appropriate credit to lend money to. But in the case of HPS, we spent a lot of time talking to individual private companies as well, which if covering private equity sponsors is a manual business and one that requires significant staff, it's one of the interesting barriers to entry in our business is how manual it is. Our collective businesses. I think trying to find those on an individual company level is even more manual and even more inefficient, which I think we would all agree. I think the existence of these staffs it's one of the key expertises in running a good direct lending business. You need to have people that can build long-term relationships with either private equity firms or with private companies. And you need people that can also really shepherd a potential investment from the nascent stage when you're just talking about the art of the possible up through the nitty-gritty negotiation of what the document actually says and all the downside protection that Mitch was articulating to final signing. And so it is in many ways a relationship business. The loans that we make in particular to private equity sponsors, we might not lend to that company again, but we will have the conversation with those same owners of companies over and over. And I think that's really a hallmark of our business is if you do it well, you will get repeat business. The non-sponsor part of direct lending is a particular focus of HPS. I think about 80% of the capital in direct lending is lent in support of private equity transactions. But when you take a step back and look at the non-investment grade landscape in the US, and these are high yield bonds and leveraged loans, non-investment grade rated loans and bonds, just over half of those rated loans and bonds that are arranged by investment banks and sold to fixed income departments of insurance companies and pension funds, et cetera, more than half of those are not private equity backed companies. So that is a large addressable market, again, a highly inefficient one to try to address. The way that we've structured our business is aligned around industry verticals. And so building industry expertise where those individual originators are repeatedly going to the healthcare conference, or the chemicals conference, the software conference, and trying to understand the trends in the individual industry so that they can be a thought partner to individual companies. And they will directly target companies that they think are growing and interesting and try to see if instead of maybe raising dilutive equity, there's an interesting investment where we can provide the company debt to help them accelerate their growth path. It is again, a highly inefficient process. I think it's one that we think is worth it at the end of the day to pursue. But it's certainly one that we've seen grow over time from an opportunity set perspective.
That's great, Mike. And then maybe just staying with you for another minute, as we talk about the more liquid side of fixed income where you have an investment bank arranging a deal, syndicating it out, really that business model is a lucrative business model for banks. They earn fees for doing that. Can you talk about, in that first slide that we had flashed up, one of the terms was alignment of interest? Maybe talk about that a little bit more. That would be helpful.
Sure. And I do think this is a key difference when we're talking about investing in the non-investment grade credit markets. One of the key differences between purchasing a bond arranged by a bank and a direct lender is that we live with the investments we make. The strategy is we're not thinking about what can be sold to other people. We're thinking about the kind of risk-adjusted returns that we think are attractive to own over the next 3 to 5 years. And we want to, so from an alignment perspective, it's really important for direct lenders to pay attention to the details, because we are going to live with any mistakes we make. That's less so for an arranging bank who really just needs to sell that risk to other people and then move on with the next deal. So we typically live with these investments from, on the short end, maybe 2.5 or 3 years, on the long end, 5, 6, 7 years. And the details of those loans are a critical part of evaluating downside protection. And we really are aligned from that perspective. We need to pay attention to the details, because those details can make the difference between getting all our investors' money back or not. And ultimately, the performance of our funds means our business either grows or shrinks. And it's not the ability to just sell something to a third party that determines whether or not it was good risk to take.
Great. And I'll turn to Craig here in a minute, just to walk us through maybe some of the characteristics of what do these loans look like? How do you get compensated? But the other thing that I wanted to touch on, and the fee component that goes to the benefit of fund investors, certainly leads to one element of where you could see outperformance to the liquid credit markets. But that doesn't speak for all of it. I think consistently there's been a roughly 200 basis point plus outperformance from direct lending to liquid public markets. I think a lot of people would step back and say, well, you're getting that because you might be taking on more risk. How should people think about that in terms of that incremental return and how you generate that incremental return?
Sure. Well, I think ultimately the reason private credit exists is that some borrowers prefer certainty at a fair price to maybe squeezing the last basis point out of the coupon they'll have to pay, but taking market risk because markets can be fickle. The non-investment grade loan and bond markets were wide open in 2021 and into early 2022, and then for all practical purposes closed in the second half of 2022. For the highest quality companies in non-investment grade space, that wasn't true, but for the average single B rated company, that was true. But private credit could look at the risk of the underlying company, evaluate those risks over the next 3 to 5 years, and price a loan that we thought was attractive for our investors and fair for the underlying borrower. So I think it's the ability to provide certainty that is baked into the price of the average loan. And I really think that's the value we as an industry provide. I also think that's the explanation for the incremental return, is that there is a price above the best possible market execution for that certainty. It is worth something, and it's worth a lot in 2022. I think we'd all agree that was an incredibly attractive market. Maybe it's worth less to some people when everyone's focused on return rather than risk. But I think the ability for us to accept some illiquidity in our funds, that's the explanation for some of that enduring return. But we are providing value above and beyond just a regular way loan that trades in the market, that can be accessible from an issuance perspective sometimes, but totally inaccessible 90 days later. Like that's what is baked into the price that we charge.
Great, thanks for that, Mike.
I should also, sorry, Richard, one other comment just from a risk perspective. I think my colleagues on the phone, I think would have very similar statistics. If you look at loss rates in private credit over time, not only are they not higher than loss rates in equivalent public market credit, that they're actually lower. And so it's not obvious. I would say, if nothing else, the risk is very similar and the returns are higher. And there is a statistical argument, and Mitch and Ares would have the longest track record through multiple cycles. And I guarantee Ares losses through multiple cycles are significantly lower than public market equivalents. You're welcome, Mitch.
I was about to thank you for that, Mike.
Yeah.
The only thing I would add that to Mike's point, guys, is remember we are picking the industries. If you're investing in the liquid market, right, and you are an index investor, and I don't want to get into wonkiness, you're perhaps investing in cyclical industries, whether it's oil, gas, automotive, real estate, housing, home building, et cetera, et cetera. I think Mike, Craig, and I, the three of our firms, would argue that we invest in non-cyclical businesses. We get to pick and choose. We self-originate our assets. We pick what industries we want. And by choosing non-cyclical businesses, we tend to outperform in any risk-weighted metric that you can come to think of, the public markets.
I think Mitch makes a great point, and you can't emphasize it enough. If you take the high yield market, one of the largest sectors in the high yield market is energy. And so when energy goes through a tough cycle, the high yield funds are going to see that impact. And say by and large, most direct lenders have very little exposure to energy in any part of the cycle. The other piece, which was touched on earlier, the due diligence. When we work on a transaction, we're typically working on it for 2 or 3 months ahead of our commitment. We get to do extensive private side due diligence, typically working alongside the private equity firm, meeting with the management team, doing our own industry consultant reports, really deep dive due diligence. If you're a public market investor in the loan or the high yield market, your information is really limited to the information provided by the bank distributing the deal. Your decision time is measured in days, maybe if you're lucky, a week or two, and you don't have access to that private side due diligence information. So it stands to reason, if we can pick the most stable sectors and study the companies in great detail, that would explain why our credit performance and therefore our returns are better than the public markets.
Craig, we'll come back to you on a few characteristics. I did want to pause and see if there are any questions from the board based on what we've already touched on, or to take us a different direction.
Richard, if I may, I'll call on those who will indicate they have questions by raising their hand on the Zoom screen. But in the meantime, one of the questions I have for any of our participants is, in those instances where you're financing a company that would otherwise be obtaining its capital from a non-investment rated bond, where you're doing the due diligence, what kind of protections would you have in those instances to give you that alignment of interest and create some protection?
Why don't I'll jump in and I'll direct that to Craig. Craig, as I said in your bio, obviously, you ran the high yield desks for some leading investment banks, and also you haven't had as much time to speak, so I'll let you take that one.
All right, thanks, Bill. Look, the credit protections are critical to underwriting. I mean, we are taking long-dated illiquid risk, and so we need to make sure when we're making a loan to a borrower that's going to protect us over a long time period. And so we negotiate really detailed credit documentation, 100 pages of documents, where we're basically governing how much debt can go on the company, whether any dividends can go out, what their capital expenditures can be. We really restrict other creditors from coming into the companies. We typically have what's known as maintenance covenants, which is the company has to have a certain level of performance during the life of our loan. And to the extent that their performance falls below that level, that gives us a chance to sit with the borrower and find out what's going on. And so this is critical. I mean, as you said, these are non-investment grade loans. I mean, nobody should be under any illusion to that. Typically, they're really good companies. They could be investment grade, if they wanted to be, but they're choosing a certain leverage level, certain amount of debt on the company that would make it non-investment grade. So these credit protections are critical to protecting us during the life of our loan.
Great, thank you.
Thank you.
Yeah, any other questions? I'm scrolling through to see if any hands are raised. All right, we can move on. Thank you.
Great. So Craig, staying with you, I think it would be helpful to talk about the source of your return. You know, what are maybe just a little more detail around the attributes of these loans? You know, what's the typical maturity? How are you generating that rate of return? And then once you cover that, maybe taking a step further up and saying, all right, now you have a portfolio of loans. How do you think about construction?
Sure. So we are making loans, and they're typically floating rate loans. The term of those loans can be anywhere from 5 to 7 years. It's rare they're beyond 7 years. And at the end of that period, the loans are due at maturity at par, at 100 cents on the dollar. Because they're floating rate, there's a base rate that's set off of an index. In the leveraged loan market, in the market that we're talking about, the typical indices that we are all using used to be LIBOR. LIBOR is in the process of being phased out and being replaced by a similar index called SOFR, S-O-F-R. It's an acronym. That is a market set rate that varies every day. So typical terms on a loan would be SOFR plus a spread. In today's market, and I'm going to generalize here, spreads are approximately 700 basis points or 7%. The SOFR rate today is about 4.75%. So our loan, when we make it, would be a combination of those two numbers, 7%, 4.75%, we're earning close to 12% just on the base interest rate. The index will move up and down during the life of our loan. I'm sure everyone on this call recalls a year and a half ago, those base rates were very low, less than 1%. So they can move around. That's the floating rate mechanism for our loans that we're protected by. The spread stays the same. In addition, we get upfront fees from the borrower when we close on the loan. And that's typically 2 to 3% of the principal value of the loan. Now we get it upfront, but typically we'll show it to our investors as if it is spread over the life of the loan to give you a sense of the overall impact of the life of the loan. So we're earning close to 12%. If you add in the fees, you're earning more than 12%. Just for some frame of reference, I know we'll touch on this later in the call, what a good environment it is. About a year and a half ago, that same loan, we might have only been earning 7 to 7.5% versus 12.5% today. One of the reasons why we're also excited about this current opportunity, just the higher rates have really benefited this asset class. The loans get repaid in 5 to 7 years. In the first couple of years, we typically have what's known as call protection. So if the loan gets repaid quickly in the first year or two, we typically get some additional return for that. In today's environment, you might earn another 1%, give or take, in the first couple of years if the loan gets repaid quickly. So adding on to that 12%. So that's the economic profile. And these are floating rate loans, and they're also first lien loans. We haven't talked about that. We're typically the first creditor in the company's capital structure, and typically the only creditor in the company's capital structure, which is very important for our downside protection. Maybe moving on from there for a second. You asked about portfolio construction. And I know many of the folks on the board were probably more familiar with the private equity asset class, and I think it's helpful to compare. We're lenders. Our upside is really limited. We don't have upside. We're making loans where we expect to get our principal back at maturity at par. And so if there are any credit issues, and we were to incur losses, even though we tried to make the case today that we're really good at avoiding losses, if losses happen, they just eat into those returns. As a lender, we don't have the opportunity to have our winners' gains offset our losers. It's very different in the private equity business. In the private equity business, the winners can have a really great gain on one company that might offset a loss in another. Because of that factor, It's critical when you're constructing a portfolio of loans to have a highly diversified portfolio. It's fundamental, I know, to Mike and Mitch, in each of our firms. So what does that mean? Typically, we might have a minimum of 150 different borrowers, 150 different loans, and it may be as much as 200-300 different loans in the portfolio. So any one position size might be less than 1%, it might be less than 0.5%. And this is critical because if there's a problem, you want to make sure that problem is very limited to the portfolio, so its impact on the portfolio is very little. Again, to compare it to the private equity type fund, and those are terrific funds. I'm not taking anything away, but it's a different economic profile where their winners can offset their losers. They're more concentrated. So they might have only 10 to 20 investments in their funds versus us having 200 investments in the funds. Our bite sizes are less than 1%. Their bite sizes will be 5 to 10%. Again, that makes total sense if you're in an equity product and a loan product who really benefit from having high degrees of diversification.
Thanks, Craig. And last question for you before we move on. With the term private, I think a lot of people immediately think illiquidity, which is fair. But private credit, the illiquidity maybe versus some of the other private investment areas, and you did the comparison to private equity in terms of diversification. I think it might be helpful also just to talk about the velocity of capital. Obviously, you have current income. I think Mike Patterson made the point of, while it might be a 5-year or 7-year loan, your experience in terms of what is the average holding period, that would be helpful. And then even though CalSTRS has the luxury of being able to set up single investor funds with groups like yours, the typical profile of a fund is what? It's a 3-year investment period, right? Versus, other private investment asset classes, which are much longer. So that would be helpful just to touch on that, I think.
Sure. So I mentioned a minute ago, our loans are typically 5 to 7 years in term. But as you're pointing out, we don't expect that the loan will actually just get repaid in 7 years. In fact, it's highly unlikely that it will go that long. I mentioned the first year or two, we have call protection, but after that call protection wears off, it's very common for us to get repaid on that loan at par in years 3 or 4. I would say the typical life of our loans is 3 to 4 years. Why is that happening faster? Oftentimes, particularly in the private equity-backed deals, the sponsors are building companies, they're growing them, and at some point, they find it helpful as the company's scale has grown to refinance the loan and put in place a new capital structure more appropriate for a company of much bigger size. When they do that, they repay our loan. They might sell the company or 3 or 4 years or take it public. And so in that case, again, they repay our loan. So when we make a loan, we typically expect a 3 or 4 year average life. What's nice about that is I talked about those fees up front that we earn, which again, we get the cash essentially in up front, but I like to think about it as being earned over the life of the loan. I think that's a more conservative way to look at it. But when the loan does get repaid earlier than maturity, essentially our investors get all that income, in at that point in time, and it can further boost returns. In terms of a typical portfolio, or how does it work? How does a fund work? You started to touch on this, and you're spot on. It's typically a 3 or 4 year investment period, and then a 3 to 4 year harvest period. So we're raising the money, we're putting it to work, and then after 4 years, as the loans start to get repaid, we'll start to return that capital to our investors. But the return that our investors are getting is the vast majority of it is just through income on the portfolio. It's that 12% that we're talking about. Our borrowers are paying us quarterly. Most of our fund structures, we're paying out quarterly dividends every quarter. So these are really attractive income generating portfolios. You don't have to wait, in the case of a private equity fund, for a company might be 6-7 years before there's a realization for you to earn a return on investment. Our investments start generating a cash return in the first quarter we make the loan, in almost all cases. And so it's a really nice economic profile. The other point I would make, before I close is, while the typical structures today might have that 3 to 4 year investment period, 3 to 4 years return of capital, increasingly many of our clients there's a ramp period before your money's working. And then there's a period where you're returning capital, and you essentially have to climb that mountain again of making a new commitment and getting the money invested again. And so your percentage of time the money's actually working, is not 100%. And so firms like CalSTRS that have a very long time horizon, we've been working with them and the others on the phone as well to have funds that essentially allow them to keep the money working if they choose to do so in a more permanent nature, so that they don't have to keep going through this ramp period and just keep generating income, in a very consistent manner on that quarterly basis for years to come. The market has been trending a bit in that direction.
Yeah, no, that's great, Craig. And I think the underlying point here, if we didn't say it this directly, is, it's really a strategy that is wholly reliant on contractual income. You're not looking for capital appreciation. You're not, to, I think, Mitch's point earlier, as long as the enterprise value of the company's worth is above the value of the loan, you'll get repaid and you'll make your principal plus your fees and coupon. Whereas obviously the CalSTRS private equity team has been highly successful at generating great returns over time. And that's a different profile of having the opportunity to generate outsized returns. This is very fixated and focused on contractual returns. I think moving the conversation along, we did want to, Mitch, maybe if you could walk us through a slide that came from Ares that helps talk about the progression of private credit vis-a-vis banks and vis-a-vis the public debt capital markets. So if we could pull up the next slide, and maybe you could just touch on some of the major inflection points on this slide.
Sure. Thanks, Richard. And I'm glad you characterized this asset category as not new. If one would read the papers these days, you would think the direct lending business is very new and a nascent asset class. And in fact, it's the complete opposite. This is an asset class that has been growing and developing for decades. And it really started pre the global financial crisis, even well before that. And it really started as the banks started consolidating in this country. If you just think about a JP Morgan, for example, JP Morgan today is a combination of Chemical Bank, Manufacturers Hanover, JP Morgan, Chase. If you think about Bank of America is a combination of Bank of America, Nations Bank, Fleet Bank, Bank Boston. Hopefully some of these names are familiar to some of the people on the board, but there's been massive bank consolidation over the last 30 to 40 years in this country, such that today there are 50% less banks in the country than in the 80s, right? And by the way, that phenomenon is happening in Europe as well. And as these banks consolidated, they came to the conclusion that lending, they became so big, they came to the conclusion that lending to small and medium businesses, that's why I wanted to define the SME, the small, medium, and businesses on my opening remarks, was not profitable for them. Interestingly, banks have gotten so big today, the top 5 banks control sort of 50% of the bank assets. The top 15 control 70+%. We have really a consolidated banking industry. And then the global financial crisis hit, and the regulators got much more involved in what the banks can and cannot do, whether it's the Fed or the OCC. And you read about in the papers today about certain tests and what they are allowing the banks to do with regard to their dividends and their capital, et cetera, et cetera. Well, they came to the conclusion that, again, lending to small and medium-sized businesses was not in the best interest of the banks. Now, while all of this was going on and the banks stopped lending to small and medium-sized businesses, you had a massive supply-demand imbalance. And if you take a look at how big this industry is, lending to medium-sized companies, it's hundreds of thousands of companies. It's a third to 40% of the US economy. It's $1 trillion and growing industry. So again, there was this massive supply-demand imbalance, and we, the direct lenders, started taking up the mantle of lending to this large and growing and frankly terrific industry, where our investors, as Craig and Mike has talked about, can make a really nice risk-adjusted return through dividends and income, et cetera, lending to great companies. So you have this combination of this consolidation, these massively large banks, and then the regulators, getting involved, opening the door for the direct lending industry to really provide the capital to this growing group of companies in the United States.
Yeah, that's great, Mitch. I think at one point, sort of the 2010, 2012 timeframe, there was a question on, is this a trade? Is this a tactical trade? You had the Volcker rule coming into effect, and as we touched on before, this is a lucrative business for the banks. So it was there were a lot of questions around that. I think as things have progressed, that's proven that it's not been a trade. But what do you think beyond that, maybe in terms of the business models of your ultimate borrowers, and that also has lent to this continued growth in the industry?
Well, if you think about it, it's sort of an interesting thing. While the banks don't want to lend to small and medium-sized businesses, they certainly want to lend to investment-grade companies, right? Everybody, if you are a Microsoft, if you are a Google, if you are a Procter & Gamble, et cetera, you can get all the bank financing you want. The banks will fall over themselves to lend those companies money. Frankly, each one of our businesses, our HPS Ares, are investment grade, in fact, investment grade companies, and we are able to attract as much bank financing as we want. And what the banks figured out was that it was more profitable. It was a better investment to outsource. Mike talked about how intensive, people intensive, systems intensive this business is. The banks figured out it was a much better return for them if they lent through us to the small and medium banks, companies in the country. And if you think about just Ares, and I'm sure Mike and Craig will mimic this remark, Ares has gone from zero a decade or so of bank financing to 60 to 70 billion dollars. If you multiply all the direct lenders, the HPSs, the Alrocks, the banks are invested in this business to the tunes of billions of dollars, if not trillions. They've just determined that they rather us do it. We're better at it than, right? Mike talked about the alignment of interest, and it's much more profitable to them. So as you think about the growth of this business and the sustainability of this business, we're sort of in this together with the banks in a much more profitable manner.
Great. And Chair Prezant, I'll pause here and see if there are any other questions from the board, or if you'd like us to keep going with the conversation. I think you're on mute, Chair Prezant.
Thank you very much. I'll ask just one question while others may want to be raising their hands. Do any of you have a view on the use of borrowed funds by private equity sponsors to pay dividends?
Richard, which one of us do you want to address that to?
And Mitch, why don't you take that one?
Yeah, so that's a great question. In markets, so what you're talking about is a dividend recapitalization where you want to buy out a sponsor, will borrow more money and take some of their equity out. I think we would all agree that is not a business that you want to do in normal times, right? That is a riskier business. We talked about the downside protection, the amount of cash equity a sponsor or an individual has invested behind you is obviously downside protection, and it's comforting. I will say that during more frothy times where it gets really competitive, and these tend to be times where the banks are open, frankly, and they are pitching that business because again, as long as they can sell it, it's an okay credit. I would argue that Ares does not do a lot of dividend recapitalizations. I would probably bet that Craig and Mike don't do a lot either. That we leave for the broadly syndicated market. And when there's lots of funds flowing into that market and the banks are looking for things to do, they will pitch the private equity sponsors to do that. And 10 times out of 10, or 9 times out of 10, probably better said, the sponsors will take that money and pay a dividend and reduce their cash equity in their businesses. It's not particularly good business, or business any of us probably do a lot of.
Great, thank you. Karen, I see you have your hand up. Karen Yamamoto.
Hi there. Thank you for the presentation. And I'm just going to ask just basic questions. If we can go back. You talked about that private credit exists because you can reevaluate a company. I don't know if I got that right, but then you said that because of that, you can add value above and beyond that. what does that mean? What does that mean, value above and beyond? And then also you talked about, someone else talked about a ramp or a ramp. I don't know what that means. So just basic things that I'm trying to figure out where everybody's going and where everybody's coming from.
Mike Patterson, I think Ms. Yamamoto might be referring to, and correct me if I'm wrong, Ms. Yamamoto, but perhaps when Mike was discussing the value that a direct lender is providing that justifies their ability to earn more than the public liquid markets, more than just that fee. Is that
Okay,
that
so
answering
it's
your
above
question,
and beyond the public. So it's versus the private versus the public.
Yes, exactly.
Okay.
Relative
Okay.
value.
Okay.
And what I meant to say is I think part of the service we're providing, I think Richard was referencing relative value in the private credit market versus the publicly traded credit market. And historically, there's been a significant uptick in returns on the private side versus the public side, and that's been quite consistent over time. And I think part of that is because we are able to speak for an entire loan ourselves, instead of trying to build a syndicate of, and Craig would know this better than I do, having run one of these desks at a bank, but a syndicate of 100 people that all have to decide they want to do a loan. Blue Owl or Ares or HPS can do one of these loans by ourselves. If we believe it is a good risk-adjusted return, we can provide that certainty to the borrower and say, we believe this is a good investment for our investors, so we will provide you the entire loan, but the pricing has to be attractive. The coupons have to be high enough for us to think it's attractive, and that's the trade-off. And the coupons tend to be somewhat higher than what they could potentially achieve in the traded markets if they hit the window just right.
Okay. Okay.
and then Ms. Yamamoto, in terms of ramp, I think you might be referring to when Craig was just talking about the dynamic of building up a loan portfolio. Maybe Craig, if you want to describe that a little bit further.
Sure. So this is a simple point, which is, when you at CalSTRS approve an investment in one of our funds, and other investors that come in at the same time, we'll go about building that portfolio. And since I highlighted how important diversification is, we're putting in relatively small investment sizes. So it takes us time to build the portfolio, and therefore it takes time for you to have your full investment earning income. So that period of time, which could take 3 years, that's the ramp. That's what I'm describing as the ramp.
Okay.
And
Okay. So it's the way to get there.
It's the path to get there.
All right. Okay.
It takes time. And so, you have a very long time horizon. And so I was just making the point that increasingly investors like CalSTRS are coming to us saying, how do we avoid that ramp? Because during that period of time, all of our money's not working. And so we're offering structures that will essentially allow you to keep the money working once the portfolio is built.
Okay. Okay. And can I just ask one more?
Sure, Karen, you can ask as many as you want.
Okay. And Craig, you talked about the fees, the floating rate, and you get the upfront fees. And then you also talked about if the loan is paid prematurely, then what happens? And you said, did I understand this right, that those fees are returned back, or are they already consumed and they're already within all the cost of that loan?
Yeah, sorry if I made that confusing. So when we make a loan, we'll charge the borrower an upfront fee of 2 or 3% of the principal amount of the loan.
Okay.
And that loan, let's assume it's a 6-year loan, and there's 3% upfront. We'll get the 3% upfront, but the right way from an investor to look at it essentially is we spread that income over the life of the loan. So we take the 3% and we think about it over 6 years. So 50 basis points, half a percentage point a year.
Okay.
And so I was just making the point that if the loan gets repaid in 4 years instead of 6 years, we earn that 3% faster, and so the returns to our investors are higher.
Got
And
it.
so
Okay.
so it's when we the way you're going to earn a return on these funds is through a dividend. We pay a dividend out quarterly typically. And so we'll make a judgment about how fast the loans will be repaid when we make a judgment about what dividend. And so the fact that the bottom line is the fact that the loans get repaid faster than maturity means your returns are going to be higher because of they get spread over a shorter period of time.
So there's no prepayment penalty then?
There is, I mentioned this, the call protection today, and this is market dependent. Today, we're typically getting as much as 3 years of call protection or call premium. A typical term in today's market is if it gets repaid in the first year, we might get as much as a 3% additional fee in the first year, 2% in the second year, and 1% in the third year. Because those are so expensive, we don't expect to have a lot of loans repaid in that first or second year, because for the borrower, that's very expensive. So what we're really doing by having that prepayment penalty is we're really ensuring that our loan stays out. You know, I've highlighted this is a great environment. The last thing we want to do is take on the risk today, get paid a lot, but have the loans get repaid in a year when the market improves. And those prepayment penalties protect you from that happening.
Okay.
And that's a market. Those numbers I was using, they're market dependent, and so there may be periods of time then it's not as good as that. Right now, it's very attractive.
Okay. All right. Thank you very much.
Oh, thank you.
And Ms. Yamamoto, I might interject a little bit too in terms of just going back to the point on the ramp. You know, I think Glenn and the fixed income team, if they wanted to, and this is some of the differences between these markets and why we think, you know, direct lending is a great complement to fixed income. You know, if you wanted to Craig's point, put $1 billion to work tomorrow in fixed income, you know, you're working with a Blue Owl or an Ares or an HPS. They're going to find really interesting risk reward loan opportunities, but it's going to take a while for that to build up. And then I think to Craig's point, if it's done in a single investor fund, what you don't have to deal with is once those loans repay, that ramp down and then ramping back up. Obviously, the fixed income market, you know, if Glenn and his team wanted to go put $1 billion to work in leveraged loans and high yield bonds, they could do that tomorrow. So that's a little bit of the give and take here. But obviously, as we've talked about, you know, historically there has been incremental return to gain from the direct lending market, and why we would see it as a real complement to fixed income.
Okay, thank you.
Thank you.
I see Michael Gunning, you have your hand up.
Yes, thank you, Mr. Chair. Just a sense of scope. Average term, average loan size, and then market size, if you could just share. And I'm sorry if you may have touched on that before.
No, but I think it might be our next slide.
Yeah, why don't we go there? Why don't we go to the next slide and have that as our backdrop?
Richard,
helpful.
before
One
we
more.
go there, there's another board member. It's our chair, our board chair, Harry.
Thank you, Mr. Prasad. And thank you for the presentation, and thanks to you and the team for putting this educational opportunity before the board, given the important role that private credit has and will continue to play in the portfolio. I think the presentations overall have been very, very informative, helpful at the right level. I would like to ask each one of the participants how they think about worst case scenarios. What could go wrong in private credit? What do you worry about at nighttime that could change in the overall environment that could make this not be as attractive as it seemingly is at this point?
Good question.
Thank you, Mr. Prasad.
Yeah, I think great question. I think the question was really put to all three of you. So Mike, maybe if you want to lead off on that, and then Craig and Mitch, you can add anything else.
Sure, thank you. So I would make a distinction when answering the questions between what keeps me up at night around dollars we've already invested versus what keeps me up at night about maintaining the how attractive the opportunity set is, you know, new dollars to invest, because they're actually in some ways diametrically opposed. I think in terms of investing new capital, new dollars that we put to work, the most challenging environment for private credit is one where no one is worried about risk. That is a challenging environment. People don't pay attention to the details. Investment banks can sell anything that they underwrite. Those are challenging times for us because people, back to my earlier point about our purpose in some ways of providing certainty at a price, people pay very little for it and don't value it very much. So that's the most challenging environment in my mind for private credit to distinguish ourselves, is the environment when everything is just up and to the right. I think that's a difficult one. I think we like one where the details matter. We like one where where the ability to provide a complete solution is scarce and valued. That's when we get paid a lot for investing capital in frankly, a pretty conservative way, which is all of our approaches. I have a different answer for dollars in the ground. Once things are invested, I think the most challenging situation is one where there's some sort of deep macroeconomic issue. COVID, it affected specific industries dramatically and didn't affect others. I think we all have, to Mitch's point about trying to select industries, I wouldn't hesitate to say that every software investment any of us made did just fine during COVID, and in many cases outperformed as people switched to exactly what we're doing now, interacting electronically a lot. Anything we did that required physical presence, like, probably suffered in that. So, but COVID was a very specific instance. I'm talking about a more a sustained significant drawdown macroeconomically, a deep recession, like, that's challenging for all businesses. I think that's when the math that Mitch went through in his first comments about if we're invested in a company that people think is worth $1 billion today, and it's half debt, half equity, it's not that the equity needs to go down. The equity needs to go to zero before the credit is impaired. So it's not just, the stock went down by 50%. It needs to be the stock went to zero. Before the first lien senior secured credit is impacted or impaired. So, but that's, that in some ways is the most challenging scenario, just a deep, dark, long-term recession, because, that's challenging for businesses and for free cash flow. But senior secured credit is going to outperform a lot of the other options in that scenario, but it will be challenging for underlying companies.
So I'm happy to take it next. Look, the thing that we all worry about, and I think we get asked by our clients, is rates have gone up a lot, which is terrific for our portfolios. We're earning more on the loans, but obviously it increases the debt burden on the companies. And at the same time, there's quite a bit of concern about potential economic weakness later this year, given what the Fed has been doing. So I think we all worry to a certain extent. To the extent the economy weakens and the rates are higher, how do the companies fare? But this is fundamental to what we do. And I'll tell you, and I think I speak for HPS and Ares. We didn't just think about that in the last 12 months. We've been thinking about that, since we started our business. When you make loans that are 7 years, you need to underwrite to a recessionary environment, and so that is why we pick recession-resistant sectors like software and healthcare and food and beverage. And so we worry about it. But I think that direct lending will fare, well, even in that type of environment. Each of our firms are large platforms. We have large pools of capital thanks to partnerships with folks like CalSTRS. But what that means is we can lend to much bigger companies than the direct lending space has typically experienced. I would say, probably around the table, our average EBITDA today is closer to $200 million of EBITDA or cash flow. These are really big businesses that have wherewithal, even if their coverage ratios in a higher rate environment are impacted, they should have enough to make it through. The other piece I'll say is they're illiquid loans. If there's a problem, we're going to work that problem out ourselves. We can have a company struggle. What we really want to avoid is when they struggle, taking a sizable loss on an individual loan. And we think we can underwrite to that, but that focus on downside protection, if there's a problem with credit, that's what you worry about. But I think that's also core to our investment process.
Yeah, I don't have a lot to add. I will say this.
Can I, sorry, Mitch, jump in, acronym foul, EBITDA.
Think about it as cash flow.
Thank you.
The only thing I would add is, again, this gets back to my comment on how long this industry has been going on, and I'm going to thank Mike for the commercial. We've invested through the global financial crisis. We've invested through the pandemic. You know, our European teams have invested through Brexit and all different micro recessions, whether it was metals or mining or E&P, you know, that came up over the last 20 or so years. We see how this asset class performs in good markets and bad. And the good news is it tends to perform consistently through most markets if underwritten well. And so that gets back to the theme I think you're hearing us all talk about. We're not index investors. We are bespoke individual investors to companies in the United States, where we spend a ton of time dissecting the business model, the P&Ls, et cetera, to make sure we understand how these companies will perform. And we are all worried about economic slowdowns, such that we hope our companies and their management teams execute to their plans or know how to bob and weave and adjust to the market's environment as they change. And we all think we invest with great management teams. And if all of that works out, history shows that this asset class tends to outperform, and our clients, you know, get their fees and income and dividends consistently. It is not volatile like other asset classes, right? We have lots of downside protection, but aside from economic downturns and exogenous events like a pandemic, you just have to hope and think about your individual credits, the hundreds upon hundreds of companies. And that's what you think about as the economy changes and things change in the markets.
Hey, I think that covers that. I think very good question that Harry asked. And if you could address the question that Michael posed just before I interrupted.
Yeah, that's great, Mike. And if you, I think Mr. Gunning had some questions for you about size of market. I think this slide speaks to it. One thing to clarify, and Mike, if you don't mind, I'll say, you know, those blue bars on the left, that's all of private credit. If you remember my comments up front, there is a lot more to private credit than just direct lending. However, that growth ramp has really been driven by direct lending. And I guess the question to you, Mike, would be, as you talk through this slide, is what gives you conviction of that move from 2021 to 2027? That's a pretty sizable move. And then maybe you could touch on what the bars are on the right as well.
Sure. And I think Mr. Gunning, Craig said, which I'm sure is the average company in our portfolio, it sounds like in Blue Owls as well, and probably in Ares, is, you know, it's somewhere between 100 and 200 million of cash flow. And if we think that on average somebody's borrowing, you know, maybe 4.5 times on average cash flow, that some less than that, some more than that, depending on the industry and what we think is appropriate, there's your size of the loan, you know, several $100 million, 400, 500, $600 million, like for an average loan. And then the size of the industry, and, you know, we've all participated in this today. And I think these are, I'm trying to look at the source data here, but, you know, it's roughly $1.2 trillion is the total. And those are the assets available to deploy in private credit. That's how it's measured. And the comparison on the right-hand side is the size of the leverage loan market in the US and the size of the high yield bond market in the US. Those are the two publicly traded asset classes in non-investment grade credit. So it's the same, you know, same sort of type of lending, but the publicly traded side. And so I think just from a scale perspective, you can see that it's, and if we did this chart over time, you'd see that those publicly traded pools of non-investment grade capital, they are growing much more slowly than private credit. And dramatically so. And this, you know, this particular projection has it eclipsing. You usually see the crossover point somewhere 2024, 2025. You know, given growth rates. Why is that important? I'll again, go back to my point of, well, I think private credit really shines when we can provide a complete solution, when we can provide certainty. The really dramatic growth in private credit is not more small companies borrowing from private lenders. Like that has been a feature of the market for the last 15 or 20 years of private credit being very active in that space. The big growth are increasingly larger companies choosing to go the route of private credit. And that's why you see the growth really accelerating. And this is data we don't have on the page. It's from the data source is direct lending deals. So there's no way that they have fully comprehensive data, but they think that 51% of the dollars invested in direct lending in 2022 were in loans of 2 billion or greater. That number doesn't quite sound right to me, and I think we would probably all squint at it a little bit and wonder if it's exactly right. But the theme is many larger companies choosing to go the route of private credit because the public markets can't really satisfy what they want to accomplish. 2022, that was really dramatic because the public markets were functionally closed. So if you wanted to finance a big acquisition in the second half of 2022, you probably talked to the three of us and a couple of our other compatriots. So a big part of this growth are bigger and bigger companies. I wouldn't be surprised. We all said the average company is somewhere between $100 and $200 million of cash flow. That number might be 50% bigger or 100% bigger. You might double the next time we all get together and speak, if it's a couple of years from now, because these bigger and bigger companies are looking to private credit. And I think the really interesting part of that, we are credit investors, so we prefer stability to growth. We don't really benefit from growth. We just want everything tomorrow to look like it did yesterday, and then everything's fine from our perspective. So these bigger companies, they tend to have bigger, broader franchises and more diversified customer bases and more diversified supplier bases. There are a lot of really good credit aspects of these bigger companies. And so from our perspective, one should actually be happy thinking about risk-adjusted returns to get paid a little less to lend to a really good big company. We don't. We actually look at it in 2022, and we did not get paid from our perspective any less to lend to the bigger company versus the smaller company. I can't say that'll always be true, but it's true right now, and it's one of the reasons that I think we all come back to how attractive today's market is from a private credit perspective. We think we're actually taking less risk and getting paid more, which is pretty interesting.
Michael, does that answer your question? And do you have anything else to ask?
No, that's actually very good. No, thank you. I'm good.
Great. Thanks, Michael.
Mike, I might press on that a little bit. As you alluded to, 2022 was a great market for direct lending, partly because the public markets were dislocated and it wasn't a friendly home for finding capital. One of the questions I have for you is, in a more benign environment where those markets that are represented by the bars on the right are functioning well, and as we alluded to, as you gain market share from this lender or this borrower base, I should say, somebody's losing out. And that tends to be the banks, right? And they're losing out on fees. And there was an announcement just a few weeks ago, and I didn't say this in the background of HPS, but the origins of HPS were housed within JP Morgan at one point in time. JP Morgan just came out recently and said, we're going to push 10 billion into direct lending. Obviously, a lot of the other investment banks do this already within their asset management arm. It feels to me the banks are trying to figure out a way to get to not lose too much here because it's lucrative business. So how should we think about that? I guess the ultimate question, long-winded, is there a risk that there's too much capital coming your way? Is there a risk that this becomes too much capital for good borrowers?
We can't eliminate that as a risk. That is not the market balance that we witness today. And I would say I found it fascinating that the financial newspapers of the world wrote articles when JP Morgan announced they were lending money. That did make me smile a little bit because it is pretty core to their business to actually lend money. And while 10 billion is obviously on an absolute basis a huge amount of capital, relative to the private credit franchises that are on this call, it's actually not hugely relevant. it is relevant, and they're an active participant and an important part of the ecosystem. But part of the point I think Craig was making is if you compare that to the amount they lend to the funds of Ares and Blue Owl and HBS, it will pale from a scale perspective compared to the real way that they're approaching this market, which is to participate as lenders to funds of other private credit franchises. So I think JP Morgan having an active role in this space, frankly, I think it's perfectly fine. I mean, it's it is a business that they haven't had on balance sheet in a long time. They're active participants in the syndicated markets. And I think their vision is to be able to go to a client and say, we'd like to syndicate a deal, but if you're not going to syndicate the $1 billion loan, can we take a piece of it? And somebody on this loan is going to have to lead it, like from a scale perspective. That's practically how it's playing out. And what we haven't seen is in more challenging markets when maybe mistakes are made or defaults have to be dealt with. How does that work inside a bank? I mean, that was originally why they went the other way, so that they never had to deal with a default that they have to talk to the regulator about. And if you do this, you will eventually have defaults that you've got to talk to your regulator about. And we'll see long term whether it's a business that they want to grow or it's just a sort of a marker that they want to have an option to maintain client relationships, which is currently how we view it. Not really leading the deals that Ares and Blue Owl and HBS want to lead, but participating in them. So I think one of the competitive moats that we've all tried to build over time is scale. The ability to provide certainty at the upper end of the market, like they're certainly not competing there. But another important part of scale in all of our businesses is the ability to fund all the activities that are an important part of a long-term successful private credit fund that you don't necessarily see every day. All the restructuring teams we have. I mean, hopefully we never have any defaults, but I guarantee everyone who runs these firms who was on this call, have really well-funded large restructuring units that most of the time we don't make mistakes and don't do anything, thank God. But we all pay for them and we keep them around and we keep them actively engaged because that frankly is a benefit of scale. We're able to do that because of the size of the overall business.
Richard, I just want to give you a time check here. We've got a little less than 15 minutes. So, just use that wisely because I think there'll be some wrap-up comments made by staff.
Great. No, I appreciate that. In the interest of time, if we had a last slide here that was provided by Alrock, Craig, per Chair Prezant's comments. Maybe if you could walk through those. So if we go to the next slide, sort of quickly at a high level, I think we touched on a lot of these. Maybe one of the things that Mike just commented on, if we do go into a longer drawn out recession where you don't have a lot of central bank capital coming back into the market, just talking about how you're set up to deal with that is one thing. There is the scenario of that $1 billion company that might only be worth 400 million. So i.e. it is below that 500 million, and maybe talk through what happens at that point. But if we could go to the next slide, I think Craig had a number of, I think, compelling points here about the existing market. I'm not seeing. Yeah,
Jonathan, could you put up the third slide? That's not it.
Actually, the other way, please. There we are. Great. So, Craig, I'll turn it over to you, and if you could.
Yeah. So, look, I think this slide does a nice job of capturing some of the themes. I'll just hit it quickly because I know we're tight on time. Our documentation is superior. We negotiate it direct with the borrowers. It's meant to give us a seat at the table if there's a deterioration in credit performance, and protect our loan to avoid that scenario where there are greater losses. I'll come back to the workout point in a minute. We talked about higher rates, that we're benefiting from higher rates. We didn't really hit the point about the private equity sponsors, not only the capital that they put beneath us in the loans, which is usually at least half of the value of the company, but because of that capital, they're very motivated to step in if there's a challenge with the company, and to have the company change strategic direction to preserve their value. They can bring in a new management team. They can provide additional capital. And we saw this during COVID. The companies that did have problems, private equity firms stepped in and provided additional capital. It's a huge downside protection. And then I think we went through the economics, pretty thoroughly. We make illiquid loans. We're going to hold them to maturity. You have to be in a position where if the company has a problem, that you are able to step in as a lender to preserve value. And I think that we each have significant teams that's their role. And we also have the time horizon to be able to make decisions, not just based on the next 6 months or 12 months. It's a huge, I think, advantage of direct lending. If you're an investor in the high yield bond market or the public high yield bond market or the public leverage loan market, and you have a company that's going through distress, it's really hurting your returns for that year. And you're probably going to want to sell that loan to a distressed investor. We don't take that approach. If one of our companies is having trouble, our covenants will usually bring us to work with the management team. We increase documentation. We can take control of the board, and we can come up with a plan based on the specific situation that maximizes our ultimate recovery. We've had situations, thankfully, we've had very few credit problems, but we've had one or two that turn around very quickly, and we're already back to having a well-performing credit. And there's one or two that it's a much longer time period, but we can take the right time horizon. We have the resources to support the businesses to ultimately maximize our recovery. The other attribute that we have in the private credit space is we're typically the only lender. There may be a couple other lenders like HPS and Ares alongside us, but we don't have other creditor classes. You'll hear a term, it's a very graphic term, but I think it paints the right picture. Lender on lender violence. This is a phenomenon in the public markets. When a company gets into trouble, different classes of lenders will try to use contractual loopholes essentially to try to take value from each other. That's not a factor that's really at play in the direct lending market. It's another reason why our recoveries we think are going to be much higher. And so, hopefully we have very few problems, but when we do, our recovery levels will hopefully very high and contribute to that overall return being better than the public markets.
Great.
Yeah, no, I think those are good points. I think sort of stating the obvious on the math, if you think through also the downside protection element of, in an example where, as I described, that company that was worth $1 billion is now deemed to be worth $400 million. Obviously, that's off of a $500 million loan, that's 80 cents. But if that happened in year 3 and you've been paid 10% a year for those 3 years, well, that's not going to generate a nice return on that loan. You can do the math. You've gotten 110 from putting up 100. So that's stating the obvious. That's fixed income math as well. But that is one of the other elements I think to consider here. So with that, I turn it over to see if there's any other questions. I think we've covered all the questions I had, and otherwise turn it over to you, Chair Prezant, or to staff.
Okay. Any questions from the board or from the committee members? Hearing none, I would invite Geraldine and Glenn to make any comments that they have with regard to this topic. Again, I want to thank you all, the participants on this panel, for your knowledgeable and very understandable presentation of a complex sector of private equity or private investment. And we really appreciate you taking the time and effort to do so, and look forward to seeing you again. Thank you. Geraldine, Glenn?
Thank you, Chair Prezant. Regarding the asset liability management study, we will keep moving forward and be back to you in March considering different asset allocation ranges and get your feel for risk. And we'll be building in this direct lending component that Glenn Hoshikawa and team will be building out over time. Of course, you heard about this ramp up period that they'll have time to ramp it up to some allocation that you would approve in July. So with that, I'll leave it there unless Glenn or any other questions.
Hi, thank you. It's Glenn. I just, want to reiterate that what they were talking about is a complement to the fixed income portfolio. So it would just be another tool that we can use. It'll be a useful tool, but it won't replace totally what we're currently doing in the fixed income market. So just be aware of that it is something we are asking for and we think will benefit the total fund as well as a fixed income portfolio. So with that, I think we're done.
Thank you.
Oh, you're on mute, Mr. Prezant.
Sorry. I assume that there are no public comments, but if there are, would you let me know?
There are no public commenters in the queue.
Again, thank you very much to all the participants.
Thank you.
Thank you.
Thank you. Enjoyed the conversation.
Yeah.